There's some real nice benefits to the way Social Security gets taxed. The problem, most people have no idea how this system actually works. In today's video, I'm going to walk you through exactly how this works so you can make the most of your after-tax Social Security benefit. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So to understand how Social Security gets taxed, it's sometimes helpful to compare it to something that we do understand. And let's start with wages. So if you have a job, if you have a salary, there's three basic taxes that you are subject to. Number one is federal taxes. So what do you pay to the IRS? Two is state taxes. This of course depends upon what state you live in. And then three is FICA taxes or payroll taxes. This is how Social Security and Medicare are funded. Now, FICA taxes or payroll taxes is 7.65% of your income up to a cap. You pay that and your employer pays that. So those are the three components of your taxes that you have on your wages: federal taxes, state taxes, and FICA taxes. The difference with Social Security is there is no FICA tax. So FICA tax is how Social Security and Medicare are funded. When you're receiving your benefit, you're not also paying payroll taxes on that. What you are paying taxes at is the federal level, and depending on the state you live in, potentially the state level too. So let's break this down between what do you pay at the federal level and what do you pay at the state level. Now the amount that you pay at the federal level is based on what's called your provisional income. Provisional income can get fairly complicated, so I'm going to try to break it down real simple here. Depending upon what your provisional income is, I'm going to walk you through how you calculate that in a second, anywhere between 0 to 85% of your Social Security benefit is included in your taxable income. Note, this does not mean that you pay an 85% tax on Social Security. It means that 85% of the benefit is actually included in your income. So for example, if 85% of your Social Security benefit is included in your taxable income, and you're in the 10% federal income tax bracket, essentially what that means is you're paying 8.5% federal taxes on your Social Security benefit, as opposed to 10% taxes like you would pay on any other source of income. So how do you calculate provisional income? What is provisional income and what does that even mean? We'll start with your gross income excluding Social Security. So what is gross income? Wages, interest, dividends, pension income, the taxable portion of rent income that you receive. Add all those things up, but exclude Social Security. Step number two is add in municipal bond interest. So on your gross income, any municipal bond interest that you receive, it's not taxable. But when you factor in provisional income, or when you calculate provisional income, that's something that you add back in. So step number one, what's your gross income, subtracting Social Security? Number two, add in any non-taxable interest that you have. And then number three, add in half of what your Social Security benefit was. So if your Social Security benefit is say $30,000 per year, you include $15,000 in this calculation. So let's look at a real simple example. Let's assume that you have $20,000 from a pension, you have $20,000 from Social Security, and you have $5,000 of tax-free interest. What would your provisional income be? Well, we'd take the $20,000 from your pension, we'd add back in the $5,000 of tax-free interest, so now we're at $25,000. And if your Social Security benefit is $20,000, we would take half of that, so $10,000, and add that in too. So your provisional income here would be $35,000 in this example. So what does that mean? Well, depending on if you're single or married filing jointly, there's different thresholds for what your provisional income means in terms of the taxability of your Social Security benefit. If you are single, in your provisional income, so again, we just ran through the calculation what provisional income is, your gross income plus tax-free interest plus half of your Social Security benefit. Now, if that number totals less than $25,000 and you're single, $0 of your Social Security benefit is even included in your taxable income. If your provisional income is between $25,000 and $34,000, then up to 50% of your Social Security benefit is included in your taxable income. And if your provisional income is above $34,000 and you're single, then up to 85% of your Social Security benefit is included in your taxable income. So that's if you're single. Now, if you're married filing jointly, if your provisional income is under $32,000, $0 of your Social Security benefit is included in your taxable income. If your provisional income is between $32,000 per year and $44,000 per year, then up to 50% of your Social Security benefit is included in taxable income. And if your provisional income is above $44,000 per year, then up to 85% of your Social Security benefit is included in your taxable income. So with that in mind, let's look at a few key takeaways that are important to understand about this, and then let's look at an example of how this would apply to you. The first takeaway is this: Social Security is not subject to a different tax than, say, IRA distributions or pension income. It's subject to the same taxes at the federal level. The difference is not all of your Social Security benefit is included in your taxable income. So say half of your Social Security benefit is included in your taxable income due to your provisional income. Well, that 50% is subject to the same exact tax rates that your IRA distribution or your pension or other income sources are. 50% of it is just excluded and not taxed at all. So some people think Social Security is subject to a different tax. It's not. It's just only a portion of it is included in your taxable income. Second key takeaway: if Social Security is your only source of income, or you have very little income above and beyond Social Security, you're likely in a position where less than 85% of your Social Security benefit is included in your taxable income. You might be in a very low tax bracket, maybe even a 0% tax bracket at the federal level, if you're just living on Social Security. The reason for that is your provisional income is likely a little bit lower. You don't have IRA distributions or pension or interest or dividends that are increasing that provisional income benefit, and only half of your Social Security benefit is included in that calculation. So you're likely in a position where a lesser amount of your Social Security is included in taxable income. However, if you're in a position where you have a decent amount of pension income or interest income or IRA distributions or anything else that's driving your provisional income up, you're probably in a situation where 85% of your Social Security benefit is going to be taxable. Again, that doesn't mean 85% tax, but 85% included in your taxable income and then subject to whatever tax bracket you happen to be in. Here's the big kicker though, and the not so great news. Provisional income thresholds are not subject to inflation. Practically speaking, what that means is each year fewer and fewer people have less of their Social Security benefit taxed. To understand what I mean by that, let's take a look at a basic example. Assume that you're single and in 2022 your only income sources were $10,000 per year from a pension and $30,000 from Social Security. Well, let's run through the provisional income calculation. We start with your gross income, excluding Social Security. So in this case, it's just $10,000. We add back in any tax-free interest. So in this basic example, there wasn't any. So we're still at $10,000. And then finally, we add in half of your Social Security benefit. So if your Social Security benefit was $30,000 per year, half of that is $15,000. So $15,000 from Social Security plus $10,000 of pension means your provisional income was $25,000. If you remember the tables, what that means is none of your Social Security benefit is included in your taxable income, which means the only thing you're really taxed on is that $10,000 pension, and just applying a standard deduction would completely eliminate any taxes on that. So you're in a 0% income tax bracket. Here's what happened though. 2023, there was a nice cost of living adjustment for Social Security because inflation was very high in 2022. So you received an 8.7% increase on your Social Security benefit between 2022 and 2023. What does that mean for this individual situation? Well, his pension is still $10,000 per year, but his Social Security benefit went up by 8.7%. What that means is it's no longer $30,000 per year, it's $32,610 now per year. So now if we take half of that benefit, we get $16,305. Add that to his pension, and what we can now see is this individual's provisional income is now $26,305. So the reason it went up is because Social Security received such a healthy cost of living adjustment. Here's the problem. Provisional income thresholds stayed the exact same. They've always been the exact same. So as Social Security is gradually giving you cost of living adjustments, or as you're gradually taking more and more out of IRAs or other taxable accounts, what's happening is these thresholds that started here, it made it so that a decent number of people weren't paying any taxes on their Social Security benefit. Well, as income is gradually going up with inflation, these thresholds are staying exactly where they are. So people are being inflated out of these provisional income thresholds, and practically speaking, what that means is fewer and fewer people each year have less of their Social Security benefit taxed because of that. So that's how taxes work on Social Security at the federal level. Now, what about the state level? State is interesting because you have 50 different states, and 50 different states have their own unique tax law. Now, the good news is only 11 states actually assess a tax on Social Security. So for example, I live in California. California is one of the highest income tax states in the nation. Now, if you're retired and collecting Social Security, even though California has a very high income tax threshold, they don't tax Social Security. So it's not just simply looking at what is your state's tax bracket, it's understanding how do they tax Social Security specifically. So only 11 states tax Social Security, and it's not even a full tax, which I'll explain in a second, but those 11 states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, and Vermont. The remaining states, including District of Columbia, do not tax Social Security benefits. And even the states that do, there's often some reduction or some benefit or offset to the Social Security benefits you collect. For example, in Colorado, you can deduct up to $24,000 per year from either your Social Security benefit or pension when including that in your taxable income. So the good news is in most states, Social Security is not taxed, and even most of the states that do tax it, there's some offset, so that most of the time not your full benefits actually included in your taxable income. Understanding Social Security benefits and how they're taxed is crucial, because when you start to understand how these taxes work, you can really maximize the tax effectiveness of your Social Security income throughout retirement. And what you can start to see is one additional dollar in Social Security income can be a lot more tax efficient than one additional dollar, say, in IRA distributions. That's because most states are not taxing it, and even at the federal level, at a maximum, 85% of that benefit is included in your taxable income. So knowing how Social Security is taxed is a great start. But if you truly want to maximize your benefit, make sure you watch this video here, where I share with you 4 simple things you can do to make the most of your Social Security benefit. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.